A business owner walks into my office wanting a second home for $560,000. He owns his own company, owns 3 properties already, and most lenders look at his tax returns and just say no. Or they push him into a loan with a higher interest rate and a bigger down payment. We helped him close with just 10% down, 6.75% interest rate, a regular loan, just like the kind that most people get on their first house. The difference wasn't the actual loan, it was that we actually knew how to read his tax returns. I'm Ricardo Carrillo with RC Lending Advisors. Every week, I break down a real deal that we just closed. Real numbers, real strategy, why we did it the way that we did it. Here's how this one actually worked. My client owns a business and he files what's called an S-corp tax return. That just means that his business is set up so that the profits flow through to him personally. Here's where things got tricky though, and where they normally get tricky for self-employed borrowers. Business owners legally can write whatever they want off: equipment, a piece of their car, things that lose value over time. But by the time that you add all of those things up, the income on the tax return looks way smaller than what they actually take home. So when a lender looks at the tax returns, the income on paper looks really low. And so most banks just stop there. But here's the thing that most people don't know. The number that's at the bottom of the tax return is not actually the number that we have to use. There's a process called add backs. It sounds complicated, but really it's not. When you're a business owner, your tax returns have expenses. And on those expenses, there's actual cash that's being left behind that's in your pocket. One of which is actually called depreciation. Now, depreciation is something that the IRS lets you write off the value of something like equipment or a building over time, even though you didn't actually spend money on that this year. We're allowed to add that money back to your income for loan purposes, because the truth is it's a fake expense and you still have that cash. It just doesn't show up on the tax returns. This is kind of the same thing for amortization. That's a similar kind of paper write-off, as we would call it. And it's also a one-time business expense that's not going to happen again next year. So we get to add it back in. Now, when we ran the full math on his tax returns, the real income for loan purposes was actually way higher than what the bottom line was showing. And that's actually how we got him to get pre-approved for a 10% down on a $560,000 property. Here's the full deal though. The purchase price was at $560,000, left our loan at $504, down payment was $56,000, 10%. The loan type was the 30-year fixed, regular loan. We did it as a second home, and we got a 6.75% interest rate. The monthly payment was $3,200. And he also paid about $6,000 in something called discount points, which is optional money and pretty much prepaid interest that you can do to pay for a lower interest rate upfront. Why was the second home a big deal though? Because the part that nobody really talks about is that when you buy a property, the lender wants to know how you're going to use it. And there's 2 options you have. You can either do it as a second home or you can do it as an investment. But the thing is that down payments are totally different between these two. Now, investment properties means that you're going to rent it out fully year-round, 12-month leases. They require regular loan. It's typically 15 to 25% down. We're talking $140K plus in cash that you're bringing to the table. Whereas second homes are personal places for you to use. Yes, maybe you use it as a vacation house. Yes, maybe you block it off whenever you want to go use it. But for the most part, as long as you're not renting it out on a 12-month lease, you're fine. So the thing is that on a $560,000 property, we only had to come in with $56,000. Now, my client's property counted as a second home because it was a single family house. It's more than 50 miles away from where he lives. And he's not renting it out as a full-time rental on a 12-month lease. That's super specific. Those 3 things are what are important in this situation. So having it count as a second home freed up so much more cash for him to now go use it on another deal. And a lot of lenders see a business owner come in and they immediately push them towards something called a non-QM loan. Now, non-QM just means non-conventional loan, and there's other programs that you look at bank statements or profit for the business instead of tax returns. Those loans exist for a reason and they are awesome, but some business owners can actually qualify for normal financing. And if they can, we don't have to go that route. My client had tax returns that we could actually work with. We did the add backs, we ran the numbers, and I always like to look at that option first before we go look at something else like a non-conventional loan. We want better interest rates, we want lower down payments, we don't want extra fees, and so we have to go towards traditional financing for that. Now, I want to take a step back for a second because what actually happened to my client happens to self-employed people all day, every day. They look at their tax returns, they don't know what they're looking at, they give it to their tax person wants to get them more money in their pocket, so they write everything off. And so then they either give up on buying or they end up putting way more money than they actually need to try to purchase something because they just didn't have the right resources and the right team behind them. Add backs like this takes time, but it's totally possible, right? You have to go through the tax return. You have to actually read it and understand what you're looking at. And most lenders don't, because they just don't have experience with those kinds of borrowers. My client already has multiple properties. He's continuing to build more wealth, and we were able to buy another property with a significantly lower down payment than he would have needed for another deal. Here's the recap one more time. We did a $560,000 property with 56 grand for the down payment at a 6.75% interest rate and qualified using his tax returns. Now for future deals, we'll end up having to use other programs, potentially just being limited with how many properties a client typically owns. But most people don't get capped until they reach maybe 4 or 5 properties. At that point, then you have to pivot and you start using other loan programs that end up requiring larger down payments, 10, 15, 20, 25% down sometimes. But the most part, we can actually use traditional financing. This is why I always say, talk to our team. We'll look at your tax returns. We'll show you what the real numbers look like and how you could actually qualify. You can go to rclending.co to get more details on reaching out to my team and I. You can also follow us on Instagram at Richie the Lender for every deal breakdown just like this. This was a wrap on this week's video. I appreciate you guys watching. If you stuck around this long, go ahead and click here or here to watch my other Deal of the Week videos. But I will see you guys in the next Deal of the Week.